I said it was an absolutely critical pivot point, and that the BRICS, now looking at the weaponization of the US dollar and the debt levels of the US Treasury, said, you know what, we're tired of what they call seigniorage, of being the dog wagged by the tail of the US Fed and the US dollar and the US Treasury and the US yields. And we're going to just start trading among ourselves. And we're gonna net settle our trades in physical gold. We're going to come up with this Enbridge idea, which is a very strong symbol of what they really think. Look, I said in March of 2022, when we sanctioned Russia, I wrote an article called How the West Was Lost. And it wasn't meant to be extreme. It didn't mean the end of the dollar, the end of the reserve currency. It didn't mean the BRICS were going to take over the world. But I said it was an absolutely critical pivot point, and that the BRICS, now looking at the weaponization of the US dollar and the debt levels of the US Treasury, said, you know what, we're tired of what they call seigniorage, of being the dog wagged by the tail of the US Fed and the US dollar and the US Treasury and the US yields. And we're going to just start trading among ourselves. And we're going to net settle our trades in physical gold. We're going to come up with this Enbridge idea, which is a very strong symbol of what they're really thinking. Not a BRICS-backed currency, but a BRICS-backed trading, a gold-backed trading currency. Not a gold-backed BRICS currency, but a gold-backed trading settlement currency, which is what came out last year in Kazan and when Russia hosted. To me, it's irrelevant whether Brazil is now the new host, the new center for the BRICS. The real power in the BRICS is China. And the real threat to the U.S. is China, and the real motive behind these tariffs clearly is China. And it's a gamble because, Trump is basically gambling. He sees the writing on the wall. America's lost its hegemony. It's lost its productivity. It's losing its dollar to these BRICS. China's leading the way. China's playing the long chess game. They see that. We got to punish China now with these tariffs. And we got to do it now because America still has 26% of global GDP, and China only has 17% despite its bigger populations. So if we're going to strike in a financial war, let's do it now. Because the real threat is China, and the real threat is the BRICS as a team, as a group. They are clearly moving the hockey puck away from the dollar. That is a tremendous threat to the US dollar. Just as the BRICS met last year, they were also, UAE and Saudi Arabia was there talking about selling oil outside of the US dollar. And already 20% of global oil is settled outside the US dollar. Again, unthinkable 5 years ago before we weaponized the dollar. So all these signs from the BRICS and outside the BRICS of moving away from the dollar has Trump and the US incredibly scared. So these tariffs are a desperate attempt to try and bring China down. What you got to understand is the Chinese, only 12% of their exports go to the USA. They obviously don't like these tariffs, but they're creative and they're long-seating. And China has a lot of problems, but these tariffs aren't going to cripple China. They're going to hurt America more than China. And I'm not the only one who believes that. But I'm all in favor of bringing all those jobs back from China into the U.S. and all those companies like Apple to start manufacturing in the U.S. and John Deere out of Mexico and back into Iowa. I'm all in favor of that. But we're underestimating the power of the BRICS to get creative, to net settle outside of the dollar, and to find new trading arrangements, which they'll definitely do in Europe. Germans, whether they're selling Volkswagen, lumber, or car parts, or whether they're selling chemicals, they need a buyer for that. And if China's a buyer for that, they're going to have to make their own trade arrangements with China. They're not going to let Volkswagen fail. They're not going to let chemical companies fail just because America says don't trade with China. They need a market for their products. So we're going to see creative new trade agreements, regardless of what Trump tries to flex. It's a matter of survival that companies find trade arrangements. And I've talked to Germans. I went to school in Germany with some friends that are now executives in weird companies, whether it's chemicals or whether it's lumber, for God's sakes. That's another leading indicator. One of my friends who runs a big company out of Liechtenstein says, we're not going to go to the U.S. anymore to do our corporate retreats. We're not going to have 47 hotel rooms in an American hotel because these tariffs are absurd. And by the way, if we can't sell our product in America as much because of these tariffs, we're going to start selling them more in the East. Why? Because it's a matter of survival for their company, for their employees, and for their balance sheets. They're not going to just say, well, Trump told us so. I think Trump is underestimating the creativity of the West, and they're certainly underestimating the creativity of the BRICS nations to find ways to cooperate more if America tries to push them into cooperating. Some say the world will kiss the ring of the U.S. and Trump, and you already saw that when he announced these tariffs. Everyone came running to America. We're going to cooperate any way we can. That's debatable. I think from the conversations I'm having, whether it's in Germany or whether it's in Asia or whether it's in South Americans, is look, we understand why Trump is doing this. He has to bring manufacturing back to America. Besant has said it's going to be expensive, short-term pain, long-term gain. But the BRICS and other countries are not going to simply be the kneeling to the US dollar and the US White House in the next 10 years the way they have in the last 10 years. And that doesn't mean they're going to win or that China's going to emerge as the only power. Again, it's going to a new order, a new disorder, a new set of creative and uncreative, good and bad ideas to keep the U.S. hegemony and supremacy out of the picture. And that is hard for Americans, like it is hard for the Wehrmacht or hard for Napoleon's army or hard for Robert E. Lee's army to admit that they're at that Gettysburg, Stalingrad moment. It's hard to see that, not that you're dying, not that the war is over, but you're not as strong as you thought you were. It's not the country you thought it was. We are not the America that raised the flag on Iwo Jima, that was the world's largest creditor. And now we're the world's largest debtor. And we were the world's largest manufacturer. Now we're the world's largest outsourcer. We are not the America of Clark Gable and the flag on Iwo Jima and the Marshall Plan and those iconic moments. We are a broke, debt-soaked, desperate America led by donkeys and elephants, where our soldiers are lions being led by donkeys, and we're in wars that we shouldn't be in. And every veteran I've talked to would say the same thing. So, yeah, crazy times. But the BRICS, it isn't relevant whether it's Brazil or Russia or South Africa or China hosting the meeting. The real BRIC is C. The BRIC is China is the real letter. That's the real threat. That's the real target of these financial sanctions, which we call tariffs. And, it's to be determined. And again, I'm not trying to be totally critical. I absolutely am appalled by the U.S. CEOs who outsourced 6 million jobs overseas, where the American dream is clearly now made in China. And you also can't blame China for wanting a non-dollar energy solution. They don't want to use U.S. treasuries to buy U.S. oil and petrodollars. They're tired of that. So you see, they both have legitimate interests, and they're not cooperating. And so there's going to be tension, and there's going to be more and more BRICS influence, more and more BRICS creativity. Again, doesn't mean the end of America, but a very, very different America, a very, very different dollar. And that's obvious to me. Well, Kai, Hockmut kommt vor der Falle. Hubris comes before the fall. You don't want to get cocky here and say, I told you so. There's a couple ways to answer this. First of all, it depends on who your audience or who your clients are. If they're investors in gold thinking 10, 20 years out, 3,500, 2,800, 1,700, 4,200 is irrelevant to them. It's egal. They don't care because they're thinking legacy, generational wealth, their grandkids and their kids. So yeah, it's awesome to see gold go from 22 to 25 to 26 to 28 to 32 to 35. If you look at the cup and handle, we get past all the fundamental reasons why gold is going to go much higher, because world reserve currency is going to be debased, and because all fiat money eventually gets debased to monetize debts. You get past the fundamentals, the bond yields, the bond markets. Look at the technicals on a cup and handle formation, which has a 13, 14-year base. Just technically, we hit the $3,000 target. The next technical average move on the cup and handle formation is gold at 4,000, which to me is not at all unlikely. It's absolutely certain. Does that mean gold only goes in a straight line? Absolutely not. It typically, once it hits that target, it can retrace on the 200 moving day average, go back, and then launch again much higher. But again, for a long-term investor, that's irrelevant. Of course, it's going to go to 4,000. It's going to go much higher than 4,000. I'm absolutely convinced. Remember it was at 1,600. I said it's going to double in the next 5 years, and it did. And it wasn't because I was some guru or some technical or fundamental psychic. It was just the gold rises because paper money is falling. So to your question, Schadenfreude? No, it actually makes me sad because the only people really benefiting from this gold rise are the whales, the central banks, the big buyers, the big institutional buyers. The man on the street, those crazy stackers, are still a strong minority. And for them, I would like to see more men on the street, more women on the street understand gold and have the ability to pay for it and wait it out. To your question, what am I seeing? Not Schadenfreude, because this is just chapter 1, in my opinion, of a much larger book in the gold price. And for most of my clients in 90 countries, our clients in 90 countries, I never get a call about the gold price. I never do. They're buying at 32, they're buying at 34, they're buying at 18. They're just buying. They're always buying when they have liquidity. Of course, some who bought at 1,200, or Egon who bought it at 300 30 years ago, 25 years ago, he's not a gold bug. He's a banker. He was a guy who understood sound money. Gold has gone up 10x since he bought gold, and he's not yelling Schadenfreude or I told you so. He's been saying this for 25 years. And so to your point, yeah, of course, some clients who bought really low and have made so much money on the just price optionality are taking out some liquidity. They're saving in gold and spending in fiat to buy a house, pay for a wedding. We see that. And some are wondering, are we at peak gold? Should I wait for a pullback to buy? Again, if you're a trader and you're looking to make money on a quarterly or monthly basis, very dangerous trade to try and time the gold market. But that's a very different conversation. If you're an investor who's looking 10, 20, 30 years out, gold at 3,500 compared to the M2 money supply is cheap. And compared to where it's heading, it's still cheap. So if you're an investor, there's no schadenfreude right now because it's going to go much, much higher. And if you're a trader, yeah, there is schadenfreude. People that said gold was an analog pet rock, dead asset, useless. It's up 25%. The S&P is down. The dollar's down. Treasuries are down. And by the way, for the last 25 years, it's outperformed the S&P. So I'm kind of tired of being called a gold bug when you understand bond and credit risk and equity risk. It doesn't mean gold always goes in a straight line, but of course it's an outperforming asset. Of course it is. And yet it's crickets in the media. It's cricket on the Wall Street Journal. It's cricket at the Fed discussions. It's crickets in Congress for the most part, because you're not supposed to understand gold. You're not supposed to understand sound money. At Harvard, at Wharton, at the business schools, the econ classes I took, no one talks about gold. No one talked to you about the Fed when I was in grad school. But it's because they don't want you to know that. These are lies of omission. They're very deliberate. It's not a conspiracy theory. It's survival. What was the biggest question when we went off the gold standard? That book 3 Days at Camp David? What's the gold price? What's the gold price? Sovereigns that are in debt up to their ears are terrified of a rising gold price. But now they just can't ignore it. And now that narrative no longer works. And now the BAS, the COMEX, the central banks, they're buying gold. It's just that simple. Because it's the debt is now that unbelievably high. But if you're an investor, absolutely it will go much higher in the years to come than it is right now. That doesn't mean it never goes down. But yeah, you and I, we're all just flabbergasted. But at some point, as we've been, as Rick Rule said about silver, you have to be patient. It rewards infrequently but extravagantly. But I remember during the 2008 crisis with the subprime mortgages, and as mortgages were defaulting, the ABX index was going up. It was crazy. Like, how long can this last? You've got mortgages defaulting and failing en masse, and the CDO, the collateralized debt obligation that Morgan Stanley was pushing, was going up in price as the underlying asset was tanking. And we were looking, you and I talking this for years, the central bank balance sheets, the debt levels, the treasury markets, why isn't gold ripping? And it was just that moment between trap pieces where it didn't make sense. But it actually was gradually rising. And now with the debt and the inflation and the undeniable inability to cover that debt, the unsustainability of that debt, the unhaltbarkeit, it's unsustainable. Now it is becoming so obvious that not even those jackals that run the media or the Wall Street Journal or the mainstream kind of RIA industrial complex can hide what's happening in the COMEX, what's happening behind the scenes of the central banks, what's happening with central bank gold demand. It's mathematically exponential. What's sad and what's deliberate is how the retail investor is still not being told about this. How you can't go to your advisor at a major bank and get sound advice. Oh, gold is too volatile. Gold is too volatile. It's outperformed the S&P for 25 years. Gold is too volatile. It's a tier one asset by the central bank of all central banks, the BIS. Gold is too volatile. The Basel III Accords just made banks hold more of it in physical form because they know it's far safer than U.S. Treasuries, the former safe haven. I'm not making this up. This is what's happening right now. Gold is replacing the U.S. 10-year. It's happening right in front of our eyes. And yeah, now the gold price is undeniable for those of us who've been paying attention. What's sad, though, Kai, is a lot of people that still trust their brick and mortar advisor or their consensus think advisor at Bank X, Y, or Z. They're still being told to diversify into stocks and bonds when gold just broke a 10-year base on how it's outperforming the 60-40 portfolio. I know it's contrary to your prior guess, but this is math. It's not an opinion. It's just a fact.